Yo, what's up, everybody? Friday the 13th. Yeah, it's Friday. How's everybody doing? So, today was an interesting day. We got good earnings, very good earnings. JP Morgan smashed earnings record. They had a record quarter. I've been saying the banks. I've been pounding the table on the banks, and certainly I've been talking about the big banks, JP Morgan, Citi, Wells Fargo, Bank of America. Smaller regional banks, that's another discussion, even though I own a lot of the smaller regional banks, but I also own heavily JP Morgan, Citi, Wells Fargo, and Bank of America. But the interesting thing, not interesting to me because I knew this was going to happen, was Jamie Dimon said, we made huge money on interest, right? Because what is that? That's the Fed transferring income to the banks because the Fed's paying interest on reserves and the Fed jacked up the interest rates. So there you go. Like everybody, this is again, this narrative that I always talk about with these monetarists who just see everything in a single variable point of view. They're like, oh, the interest rate is going up. Oh my God. Like the income is sucked out into outer space. It's not. It's a redistribution of income. And you see this very clearly with the results from JP Morgan. They had record interest income and they made a lot of money from absorbing First Republic. Remember, First Republic became insolvent. Now, this is something I want to talk about. So this again fits into the whole understanding of, what are interest rate changes? There are price changes, there are redistribution. They're not a loss of anything. Again, the income doesn't fly out into outer space or get burned up somewhere. JP Morgan was the recipient of these income transfers, and it was because the rate hikes basically devalued the capital of First Republic, okay? And it became harder for them to attract deposits. Yeah, some of these smaller banks, they're finding it difficult to deal with the higher rate environment. But what happened, let's take the example of First Republic and JP Morgan. Those assets, it wasn't like they burned up in a bonfire somewhere. They got transferred to JP Morgan. So it all stays in the economy. It's just a redistribution. And by the way, the same thing happens on the downside. On the downside, when interest rates come down, then what? It's the debtors who make out and it's the creditors who lose. So the thing to remember is not to get all emotional and crazy about this stuff and buy into this single variable, very ignorant, it's not even understanding, but very ignorant view, let me call it that. Instead, just understand, if you understand what's going on, you could position yourself to take advantage. Like when I see, for example, rate changes, or when I see inflation, or when I see deflation, I just say, well, where do I want to be positioned within the economy, within, let's say, the stock market, or as an investor? Somebody's going to lose out, somebody's going to gain. I want to be on the side of those who gain. I don't want to sit here like crying that rates are going up, because that's just ignorance. That's just, you don't understand the dynamic of what's going on. So all you can do is whine and cry about interest rates going up instead of being smart and taking advantage of it. That's what it boils down to. That's completely what it boils down to. So first of all, I have no sympathy for people who conduct themselves like that and they're out. And by the way, I'm not trying to harp on people who are uneducated about this. Let's say just regular working people. I don't expect them really to understand this because for two reasons. Number one, they're being filled up with all this wrong information. And number two, it's probably hitting them in the negative way, right? Because they see their credit card bills go up, they see their mortgage payments go up. So they do see that single variable, the one side, and they're not informed enough to understand the other side, where they could literally not just even protect themselves, but make money off of what's happening, like to completely offset the negative impact. But I'm criticizing more the so-called, professionals in the finance industry and economics who come out with this ridiculous bullshit where they really don't even know what they're talking about. I mean, last week we had a guy from Goldman Sachs of all places, who's saying the market doesn't play by the rules. Like, there's some rules, and to him, like, if it's not acting the way in his mythological thinking of how it should act, then that's what he comes up with. This is I'm sure the guy makes, 7-figure salary, not playing by the rules. What kind of freaking analysis is that? Then you had this guy, Mohammed El-Arian. I've spoken about him several times. He used to be at PIM. He was a former chief economist at the IMF. So right there, you got to discount his credibility. Then he was at PIMCO, where he lost a lot of money, I think, as an investor. And Bill Gross, when Bill Gross was still there, got him fired. Now, I don't know where he is, but he's at some other shop. And he's another one of these guys that the financial media, they just parade him out there like some kind of, guru, some kind of genius. And he just says the stupidest things. Like today, he said that the market is what were the exact words? Something like, a drug high. The market has benefited from a drug high or something. I forget his exact words, but it was another one of these figurative expressions where it was not really an explanation at all. It conveyed zero insight and understanding. It was one of these, just the phraseology was just like this made up figurative language. It's silly. This is supposed to be some highly educated guy who's been around in the financial. He doesn't know. And then he's like, he said another thing today. He said the volatility of the bond market shows that it is not well anchored. It's anchored to Fed policy. And if the Fed is kind of shifting, we're in this kind of environment right now where, we've had 11 rate hikes or something, 12 rate hikes over the last year and a half. And now it's kind of like the Fed we don't know if they're pausing, if they want to do it again. So the volatility is like, we're in this kind of limbo where the Fed hasn't expressed clearly what its intentions are. But there's no, the anchoring comes from the monopolist. The monopolist is the central bank. They set the prices meaning rates. Okay? If you think of an example, let's say there's a monopolist. Let's talk about John Rockefeller when he controlled the oil market. And he was putting his prices up, or let's say in his case, he was putting his prices down to crush his competitors. And then he kind of stopped. You didn't know what his next move was going to be. Is he done putting it down? Is he going to put it back up because he wiped out all his competitors? So there could be a period of volatility there because his intention was not expressly communicated. Same thing here. But he doesn't understand that. El-Arian doesn't understand that, so he comes up again with some figurative language line. I just want you to know that. Be aware of these people. And I said the other day, if you watch these shows like CNBC, look, I don't watch them. You might ask, well, Mike, how do you know how he said that? It's quoted on the internet. Friends send me stuff. I don't watch CNBC. If you want to watch CNBC, that's basically saying you want to be stupid. I mean, if you want to, it's up to you. Freedom of choice. If you want to be stupid, then watch those shows because that's what'll end up happening. You're going to become stupid. So anyway, that was that. Now, today was another day, and it's why I tell you guys that it really is in your interest to be a subscriber to my report because we had that very strong earnings today. Market was up 300, almost 300 right at the get-go. It might have even been up over 300. And I sent out an email right there early in the morning. I said, it's not going to hold these gains for the reasons I've been talking about. Like, we have high bullish sentiment now. We got the tax drain next week. All right. We've had a reduction in the fiscal flows this month. And what do you think happened? It gave up all of those gains. The Dow eked out a small positive close, but the Nasdaq and the S&P were down. And if you would have sold on that email, or at least if you're not a trader, if you just would have been aware. Now I have people who I've helped in the sense, and I'm not patting myself on the back for this. I've had people who have emailed me, said, Mike, thank you very much, because I was about to do a FOMO move. FOMO, F-O-M-O, fear of missing out. That's this chasing after it. And they said, your words, your email kept me from doing that FOMO move. Now, the FOMO move is what most people do. It takes a lot of self-discipline and also understanding. When you have understanding, the self-discipline comes a lot easier. I can tell you that. When you don't know what's going on, it's very hard to be disciplined, because you do have fear. You either have fear of missing out or fear, of losing. So your behavior is affected because you don't have understanding, and you don't have, it's like if you don't have strength, if you don't have strength, you're scared, or if you don't have, let's say, fighting technique. Let's say you get into a scuffle. It's scary because you don't know how to defend yourself. But if you're adept at that, if you're very skilled at that, you're not afraid. And even in competition, now let's not even talk about like an actual street fight. Let's talk about competition. Let's say you do jiu-jitsu, right? And you're in a bad position. Your opponent has you in a bad position. If you're a skilled jiu-jitsu practitioner, you know that the thing to do is to be patient, to wait it out, to wait until your opponent makes a move that you can capitalize on and get yourself, you're not panicking. If you watch these fights, like the MMA fights, and somebody's down on the ground or something like that, a really high level practitioner or MMA fighter, they're patient. They're patient and they work themselves out of it. Same thing here. If you have understanding, if you have knowledge, you're less prone to these FOMO moves or these fear, panicky moves. And on that note, let me talk about gold, because gold, I used to be a gold trader. I was a member of the COMEX way back when in New York. So I was in the pits trading gold. I know gold very well. The main driver of gold is not geopolitical and it's not inflation. It's economic activity. If you have strong economic growth, gold is going to appreciate over time. Now, what I saw today was you got this big jump up in gold. What do you think happened there? You had a lot of people jumping in on this FOMO, fear of missing out. That was the driver today. And I guarantee you with 100% certainty that this move today is going to be reversed. And I would venture to guess that most of those people, probably all of them, were selling down in the low 1800s, like last week when gold was, I think we got down to like 1823 on the price. How do I know that? Because when I look at the CFTC report that comes out every Friday, I could see like the speculators were selling down there, and I'm pretty sure they were buying it up like crazy today. That's, again, a very good example of people who are emotional. They chase after it. It's a fear of missing out. It's not going to work. If that's your approach, there's my dogs barking again. Not my dogs, but I can never do a video without dogs barking. You know this. And the new thing now is freaking helicopters flying over. But today, no helicopters. So if that's your approach, like you just reflexively, knee-jerk, emotionally jump in and jump out, whether it's a headline or something going on or somebody says something, I mean, you're never going to, it's never going to work out. It's never, ever, ever going to work out. If you don't have control over yourself, over your emotion, if you don't have understanding, I mean, you might as well hang it up. What are you doing? What are you doing? There's other, go to Vegas and gamble. It's fun. Have a couple of drinks, beautiful casinos, whatever. You'll probably have a much better chance. Well, even there, I doubt it. But poker players, blackjack players, the good ones, they're very, very skilled, okay? Again, skills. In our profession, in investing, it's about information. It's about understanding. It's really about understanding and behavior. That's what it comes down to. So anyway, it's Friday. I got to go to my boxing class. Oh yeah, everybody. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. You need it. You need it. I don't know, like a lot of you, maybe a lot of you jumped into that gold thing today. That's not how you do it, folks. That's not how you do it. All right. See you on Monday. Bye.